The fear index is spiking and there's a ton of drama, which I absolutely love to see. Because when there's chaos in the market, a lot of amazing investment opportunities start to appear, and that allows you to buy shares at ridiculous prices. And talking about ridiculous prices, the upcoming 5 stocks are a must buy in the month March. I will show you the company, their growth rates, their valuation, their business model, and all the risks you got to know to make a well-informed investment decision. The first stock is called Zena Technologies. Zena is a drone company in a rapidly expanding sector with one of the biggest growth rates in the industry, because in 2025 alone, Zena completed 20 global acquisitions, earning industry recognition for its disciplined deal execution and leadership in industry consolidation. And this is visible in their revenue chart, going from making $2.2 million in the second quarter of 2025, and 1 year later they're expected to make $7.6 million. That's more than a 3x in 1 year. And despite all the acquisitions, they're still forecasted to improve their EPS numbers, which is quite impressive. Now with these growth rates, you would think that they will be trading at insane price to sales ratios, but if you ask me, a price to sales ratio of 11 is definitely not expensive, knowing that you're growing your revenues over 200%. If you look at the 1 year chart, this stock is down more than 50% from its all-time highs. One of the reasons for that is the recent liquidation of all the risk on assets, and when a company got insane growth rates, it's usually categorized as a risk on asset. And the second more valid reason is the dilution of shareholders to be able to make all these acquisitions. This reflects a company moving from the experimental phase into a high growth execution phase. Rather than competing for hardware sales in a crowded market, Zena Tech acquires established profitable land surveying and engineering firms that have existing cash flows and thousands of recurring client relationships. By replacing manual labor with automated drone workflows, the company instantly expands the profit margins of these acquired units. The company targets a total of 25 acquisitions by mid-2026, creating a nationwide network of drone-enabled service hubs. With federal agencies increasingly banning Chinese-made drones, Zena Tech is positioned as a trusted domestic alternative. The company is developing a quantum navigation system designed for GPS-denied environments where electronic jamming renders traditional drones useless. Unlike hardware-only drone companies, Zena Tech maintains its original enterprise SaaS business, providing a foundation of high-margin software revenue that supports the capital-intensive drone expansion. This hybrid model offers both stability and exponential upside. Managing the rapid integration of 20+ small firms is complex. Any failure in merging these companies, cultures, and workflows could lead to operational inefficiencies and missed revenue targets. Now, before we head to the next stock, make sure to smash the like button and join the Discord. We have an amazing community that will support you in tough times, but most importantly, I will give you a heads up what I'm buying and selling every day. And over there you will find access to my cheat sheet where I track all the most important stocks with the best risk-reward profile. So make sure to join the Discord, link is in the description. It's completely free. The next stock on this list is an AI lending platform and it's called Upstart Holdings. This stock got absolutely crushed alongside all the software stocks. Right now it's down more than 70% from its all-time highs. But what Wall Street doesn't understand is that Upstart is a beneficiary of AI and not the victim. They're expected to grow their revenues and their EPS more than 40% in the upcoming year, which is visible in their EPS chart and revenue chart. They're right now trading at a PE ratio of 60, which is obviously a high PE ratio, but not when you're growing your revenues and EPS more than 40%. The beautiful story behind this company is that Upstart is rapidly becoming a one-stop shop for all flavors of credit, personal, auto, home, and small dollar, offering the best possible rates 24/7 in a matter of minutes. Upstart aims to make its technology the indispensable backend for every financial institution in the country. Upstart's competitive moat is protected by a self-reinforcing data loop. Every day, the platform adds approximately 83,000 new repayment events to its training data. As of 2026, the platform has surpassed 100 million repayment events, creating a massive lead over any competitor attempting to replicate its models. This data flywheel means that every loan originated through the platform makes the next loan more accurate and less risky. The Trump administration is projected to deliver the largest tax refund season in US history in 2026, with an average refund of $3,800. While this is positive for the consumer, it is a significant negative catalyst for Upstart's personal loan volume. Upstart's core demographic of low to mid-income borrowers often uses personal loans for debt consolidation or relief. A sudden influx of $50 billion in taxpayer savings reduces the immediate need for these loans, and this could potentially lead to a slowdown in their growth rates. The next stock is the energy storage stock, which is positioned in a rapidly expanding sector, and it's called Eose Energy. This stock got absolutely crushed lately, which was partially justified because they missed their revenues by at least 30%, and at the same time lowering their full year guidance by 30%. So a 30% drop is definitely justified, but this stock dropped more than 50% after its earnings release, which is definitely overdone in my opinion, and that offers you a great entry point in this stock. Because remember, it's still a very rapid growing company. Last year they grew their revenues by 700%, and for the upcoming year they're expecting a 400% increase in their revenues, which is insane. But because they're still ramping up their manufacturing, they're expecting that their EPS will decline by 200%, which is not phenomenal, but if you have a time horizon that goes further than just 1 year ahead, then this company has a lot of potential upside. It's right now trading at a price to sales ratio of 15. If you're expecting to grow your revenues 400%, a price to sales ratio of 15 is definitely not expensive. Here you see the revenue chart, and you can definitely see that it's going in the right direction, and this is their EPS chart. But the question is, what's so special about this company that allows them to grow with these massive growth rates? EOS uses zinc, a material that is safe, cheap, and abundant right here in America. The EOS battery is essentially fireproof. This means we can put these batteries in the middle of cities, near schools, or right next to giant data centers without worrying about safety. Most batteries are like a quick sprint. EOS is a marathon runner. It can provide power for up to 16 hours or more. This is exactly what the world needs to keep the lights on when the sun goes down or the wind stops blowing. Its batteries are designed, sourced, and made in Pennsylvania. This isn't just a technology story. It's a story of bringing 21st century manufacturing jobs back to the heartland. They are moving from a small testing phase to massive industrial production. They have a $23 billion pipeline of potential deals and a $700 million backlog of firm orders. Their new in-density technology fits 4 times more energy into the same amount of space. By stacking batteries vertically, like a skyscraper instead of a ranch house, EOS has solved the problem of where to put all this energy in crowded areas. EOS recently raised over $1 billion to pay off debt and fund its growth. For the first time, experts have officially removed the bankruptcy risk label from the company. It's no longer a question of if they can survive, but how fast they can grow. The primary risk for EOS is execution. The transition to high-volume automated manufacturing is definitely a challenge, and you saw this in their recent Q4 2025 revenue target miss. Next up we got CoreWeave, and this stock is also down more than 50% from its all-time highs after the recent IPO, and it's right now trading at pretty attractive valuations compared to their growth rates. Because they're in a massive expansion phase with all the data centers being built, they're expecting an EPS decline of 66%, but they're expecting that their revenues will surge by 100%. Just to remind you, this company is doing $5 billion in revenues in a single year, so growing with these massive growth rates as a mature company is very difficult, and that is also the reason why they got a lot of debt. Here you see the EPS chart. It's expected to peak in the next quarter, but after that they're expecting that their EPS will improve quarter over quarter, and their revenues are just going up and to the right. Right now making $1.5 billion in a single quarter, and 1 year from now they're expecting to make $4.3 billion in a single quarter. And they're trading at a price to sales ratio of 6.6. That explains why you should buy this company in March, because this company has officially become the fastest scaling cloud provider in history. As legacy giants like Amazon and Google struggle to adapt their general purpose infrastructure to the intense demands of the AI era, CoreWeave is there to catch the overflow with precision engineered solutions. As of late 2025, the company maintains a $66.8 billion revenue backlog, a 4-fold increase from the start of the year. This locked-in capital provides a rare level of visibility, essentially de-risking the aggressive capital expenditures required to stay at the cutting edge. This financial stability is further reinforced by a unique symbiotic alliance with NVIDIA. While traditional clouds were originally designed to host websites and databases, CoreWeave was built from the ground up for massive parallel processing. Their proprietary CoreWeave mission control agent optimizes the networking and software layers to deliver performance levels that traditional virtualized environments simply cannot match. For AI labs and LLM models, this architectural focus translates directly into faster training times for large language models. CoreWeave has also addressed the 2 biggest bottlenecks in the industry: power and pricing. The company has secured approximately 3.1 gigawatts of contracted power, with over 850 megawatts already active. By diversifying its portfolio across various providers and geographies, CoreWeave has positioned itself to capitalize on the grid constraints that are currently plaguing the entire data center market. Next up we got Nu Holding, which is basically a digital bank, which is eating up market share in every single country in Latin America, and very soon also in the United States. The company is expected expecting phenomenal growth for the upcoming year. They're forecasting that their revenues will surge by 56% and their EPS by 66% in the upcoming 4 quarters, while they're only trading at a PE ratio of 25. This absolutely doesn't make sense. This stock was trading recently at $19 and right now it's trading at $15. So right now it's giving investors a very attractive entry point because the company's growth numbers are just exceptional. They are successfully doing this by capturing over 130 million customers across Brazil, Mexico, and Colombia. In its primary market of Brazil, the company serves 62% of the adult population, making it the largest private financial institution that goes far beyond credit cards. Its ecosystem now includes high-yield savings, personal loans, insurance, stock trading, and crypto services, ensuring that as customers grow their wealth, they stay within the NU ecosystem. While Brazil is a mature market for NU, Mexico and Colombia represent massive growth engines. Nu already reaches 15% of the Mexican adult population and is the leading issuer of new credit cards there. The company is backed by world-class investors, including Warren Buffett's Berkshire Hathaway, which recognize the company's deep moat and strong cash flow, which tells you that retailers are not the only one noticing that about this company. Now, if you watched until this point, make sure to smash that like button and subscribe if you want to see more videos of mine. And don't forget to join the Discord, where I will give you a heads up every single day. And we have a great community. So I will talk to you guys over there. Bye bye.